Hey guys, TommyBryson here, and today I'm going to tell you exactly why do people sell their investments usually during December. And by the way, the best time to ever buy a stock or an ETF or security is basically when everyone else is basically selling, because basically, guess what happens, okay? Supply and demand rules apply. The prices go down, you go ahead and you buy at a massive discount. Now, the idea is that this usually happens, for example, during recessions, depressions, crazy events, pandemics, but it also happens during December time when everyone is trying to unload their stocks, and then value investors come along and then buy some of those bargains that actually pop up every now and then. And that's what I'm going to break down today in this video: why people do it, and on top of that, how you can go ahead and take advantage of it. And by the way, I'm making this video today in October or November time because basically I want you to know about this today and not in December when everything is actually going on. This way you're actually prepared and have some money on the side to actually go ahead and take advantage of the opportunity that might actually arise. And if you guys are new here, I post videos every single day, so you should also subscribe and hit the bell so you're notified. On top of that, also destroying the like button. Now, the very first thing I want to break down is basically the 3 reasons why it's a good idea to sell your investments in December, but also why it's a good idea to also buy investments during December time also. Now, the first reason is because something called a tax law harvesting incentive in the entire IRS guideline. And I'm going to tell you exactly what this is and why it benefits you, and most important, it is something that I would do personally, and I would recommend you actually go out there and do. If I do recommend it, what app do I recommend you actually do it with to actually make the whole process a lot more easier? Now, what this is basically a very simple tax incentive, which basically means, okay, is whenever you actually buy an investment, it goes down in value, but that same year, you're gonna have some capital gains tax, right? So the idea is that you sell that investment for a loss, right? And then use those losses to offset your gains. And that way you basically get to save a lot of money when it comes to capital gains tax. So in a way, let's say, for example, I bought $10,000 worth of Tesla stock. Now, guess what happens, guys, okay? I own Tesla, and I also own, for example, Apple stock. Now, my Apple stock is worth around $13,000, and I paid around $10K for all my shares. In reality, I have a $3,000 gain. But in my Tesla stock, it actually went down from $10,000, I actually paid for it, down to $7,000. Now, my plan is this, okay? I'm going to go ahead and sell my Apple stock for a 30% gain, $3,000, but then I'm going to have capital gains tax, right? But because I am selling, for example, my Tesla stock for a $3,000 loss, I can use those losses to offset my capital gains tax. And then boom, before you know it, 3K losses, 3K gain. Now I have no money to actually be taxed. And that's the cool thing about tax loss harvesting. Now, tell me why $3,000 in your example, because basically it's limited up to $3,000 and that's all you can do. So for example, if I lost $9,000 with my Tesla stock, in reality, I have to carry that loss over for 3 years. 3K 1 year, 3K the next year, and 3K the year after that. And then boom, everything is done. I got all the benefit. That's awesome. But that's the way it actually works. So whatever you actually lose, you can carry that on indefinitely, but only 3K every single year. And that's how the entire tax law actually works. And that's why a lot of people go ahead and sell their investments during December time to go ahead, offload them, and then take advantage of the write-offs. And then they basically get a lower tax bill. And that's how the entire thing works. And that's called tax loss harvesting. Now, guys, although this does sound pretty cool, I do have to be 100% honest here, okay? Tommy, is this something that you actually do and would recommend to anyone out there? The answer is that although it is pretty cool and pretty easy to actually do, the answer is it's not something that I actually do myself, because basically, whenever I buy an investment, I'm holding on for like 10 to 20 years. I'm never really selling whatsoever, so I'm never gonna have the problem of any crazy capital gains tax in the first place. But say, for example, the only way I would do this, basically, say I have a portfolio, right? And this portfolio is supposed to have a balance of maybe, for example, 50% stocks and 50% bonds, right? Now, at the end of the year, my stocks outperform my bonds, right? So now I have, for example, maybe 70% stocks and now only 30% bonds. So in this case, what would I do? I have 2 options. I can go ahead and put my money into my bonds, or for example, go ahead and sell some stocks, but then I have capital gains to actually worry about. But in this case, I go ahead, sell my stocks for a very high price because I know for a fact they're high because basically they've grown a lot over the year. And then I go ahead and I buy some bonds for a lower price because basically they have been underperforming my other investments. So in this case, I would be stuck with basically some entire capital gains because again of rebalancing. So in this case, I would consider actually going ahead, selling some investments for a loss to then go ahead and offset the entire capital gains. But in reality, because I use, for example, M1 Finance, I never have to do this because basically every time I invest $100 every single week, it knows what to buy and how much to keep the balance, and that way I'm never going to be, for example, outperforming here and then down here is too low. That way I never have to rebalance and it always stays the same. And that's called dynamic rebalancing, where basically if I want to have a 50-50 split when it comes to stock and bonds, $100 goes 50 here, 50 here, but now stocks are basically 60 and 40. Well, M1 Finance automatically buys it so it comes right back to 50-50. And that way I never have to sell or, for example, go ahead and then buy some more bonds or whatever it is. That way it's always in line with my target actually is. However, if you are interested in tax harvesting, I recommend, for example, Wealthfront. Okay, Wealthfront Investing actually has a tax harvesting feature that does it automatically for you at the end of the year, and that way, in a way, you get to save some money. But in my case, for long-term investors, it makes absolutely no sense whatsoever. At least that's my opinion, and that's why I personally don't do it. And I don't recommend it if you're just going to be holding on for the long term. I'm just being honest. I can't have two faces and lie to your face here and be like, I'll do it, but I'm not going to do it, okay? So I'm just telling you exactly what I use. And that's basically M1 Finance. I don't use Wealthfront for investing whatsoever. But if you like it and tax loss harvesting, it's a pretty good platform to actually use that for. Just keep that in mind. Now, here's the second thing you actually need to know when it comes to December time, okay? Because everyone is basically trying to do tax loss harvesting. In reality, that creates opportunities for long-term investors to go ahead and basically buy investments for a massive discount. Tell me why? Well, in reality, if the entire market gets flooded with a whole bunch of investments, in reality, the prices will go down, and then we can go ahead and buy a lot of investments for basically a massive discount, okay? And that's the entire idea. Now, I'll tell you guys a story here, just so you guys know exactly how powerful knowing this actually is, okay? Back in December of 2018, that's when I actually bought my first ETFs back then, okay? When I actually started investing into ETFs a lot more heavily, and now I have around $130,000 to $140,000 invested into just ETFs, okay? But when I first started, I saw a massive opportunity. And again, it was in December, and I noticed exactly what was actually going on because basically I read about it, and that's what I'm telling you today. So that way when it happens, you go ahead and take advantage of it if it does happen. Now, in this case, okay, let's look at this right here, guys, okay? I told you guys I started investing back in December of 2018. Now, this right here is the S&P 500 index, okay? And look at this, guys, okay? Back in 2018, the S&P was worth around 2,900. But here it is, September, October, and then in December, it actually went down by around 10 to 15% because of all the selling that was actually going on. And by the way, that's 1,000-point difference to what it is today at around 3,400. So when this happened, I actually went ahead and bought a lot more investments and took advantage of it and basically bought at a massive discount. While everyone was selling, I was going ahead and actually buying. Now, this does not always happen every single December, but I'm telling you because usually history shows that it tends to happen because, again, of all the tax loss harvesting actually going on. And that's why I'm telling you guys about it here. Now, there is one thing that I do want to tell you guys here, just to be honest and be transparent here. When this actually happened back in 2018, my friend sold a lot of investments to do the tax harvesting, but I went ahead and actually bought a lot more. But today, in 2020 December or so, I am not 100% sure it actually happened because basically, you know, with the whole pandemic, a lot of losses happened there. And on top of that, with the whole presidential election, a lot of volatility there actually going on. I'm not sure was actually going to happen in December time because basically a lot more uncertainty and a lot less predictable. So because of the entire like pandemic thing that actually happened back in March, well, people already took a massive loss back then. So they might not have to actually go ahead and sell out their investments in December time anymore. So that's also an option right there. Now, with the election actually happening, because of all the volatility, we don't know how the market is actually going to respond. If it might go up like crazy or it might go down like crazy. But the whole thing is this, okay? Your job and my job is not to go out there and predict the market. Our job is just to keep investing and be ready for when opportunity happens, so then we can go ahead and actually invest a ton of money. So here is exactly what I'm doing. I'm still investing around $4,500 every single week into my portfolio. Now, I still have a large chunk of money on the side in case when December comes along, I can actually go ahead and take advantage of it and invest a lot more money. Now, I'm only going to do that if basically I have around a 10 to 15% loss, which makes a lot of sense, and then I go ahead, buy a lot more investments for a massive discount. But again, it's not something that's guaranteed to happen. Just because it happens often, it doesn't mean it'll happen this time also. But I am ready, and so should you. And that's why I'm telling you guys about it in this video again. Now, there is something that I do want to warn you guys about, okay? Because basically, although tax harvesting is cool, rebalancing is cool, and also buying for a discount is cool, there's also the IRS to actually worry about. Because basically, the IRS, as you guys probably know, is not stupid, okay? And although people are selling a lot of investments, if you do it the wrong way, and you actually want to do this, the answer is the IRS has a law to basically kind of like not give it to you in case you're trying to be a little bit too smart and kind of outsmart them by doing a whole tax loss harvesting. Now, here's exactly what they actually do and what the law actually is. It's called basically a wash sale. Basically, wash like wash clothes, and a sell like you're actually selling something. Wash sale. Now, what a wash sale basically is for example, let's say I bought Apple $10,000 worth, right? Back in November. And then I went ahead and I lost around 30%. So now I'm at around $7,000. I go ahead, I sell the Apple stock. I take that 3K loss, but then around 10 days later, I go ahead and buy the same amount of money in Apple stock. Well, the IRS will consider that a wash sale. Basically saying, for example, you only did this for a tax incentive, and that's why we're not going to give it to you. Now, the loophole around is basically, if you bought it and you waited 30 days to actually sell, and also 30 days from when you sold to actually buy again, around 61 days in total, then they go ahead and say, hey, all right, everything is good. Don't worry about it. We'll count it towards your whole loss. Now, there's also another loophole out there, right? Say, for example, I have a holdings, for example, in the S&P 500 by Vanguard, right? That's called VOO, the ETF. Now, say, for example, I have a loss around $3,000 there, and I want to do the whole tax loss harvesting. Well, I can go ahead, sell that ETF right there, and buy a similar one with Fidelity or Schwab's, and basically have the same holding in a way, but not the exact same. That way, the IRS will not consider it a wash sale. I know what you're thinking also, okay? If you're saying, for example, well, Tommy, I'm actually married. So, for example, I'll go ahead and sell it and have my wife buy it. No, they're still counted as a wash sale. And for example, if you sell it and then buy the option to buy it 30 days later, well, they're still counted as a wash sale. Again, the IRS is not stupid whatsoever. So the best way to do it is basically, I bought an ETF, 10K, I got a loss on it. For example, I go ahead, I sell it, I buy a different but similar one. That way, it's not considered a wash sale. But if I go ahead, buy the exact same one within that 30-day period, in reality, they're going to consider it a wash sale, and in reality, I will not get the tax benefit whatsoever. So just keep that in mind right there. So overall, guys, okay, when December of 2020 comes along, it might happen, might not happen. Make sure to have some extra cash along just in case it does happen, so you can actually go ahead and take advantage of the entire dip that usually happens, but it's not guaranteed during December times. And if you want to take advantage of the whole tax harvesting, then just go ahead and learn more about it on Google, or for example, with Wealthfront, that does a very good job at it. But again, that's not something I'm actually interested in. The only thing I do is basically, when it does happen, I basically just buy and buy and buy and buy a lot more. That's all I do, guys, okay? But guys, comment down below and let me know, what do you do tax harvesting? What do you buy when the market is down? Comment down below, let me know. I'll see you guys tomorrow. Thanks for watching. If you like this video right here, well, like this video. On top of, if you're new here, subscribe and hit the bell so you're notified. And if you want to text me or talk to me, search my Patreon link down below or send me a DM on Instagram at TommyBryson. And before I go, if you want to see exactly my portfolio and my dividends, how much money I actually bank, here's the video right here. See you guys tomorrow. Thanks for watching, and as always, peace.